And welcome to the Pleasant Street Podcast with Taylor Nissi. Taylor, glad to see you again. We're on a roll here. We're into multiple episodes of the Pleasant Street Podcast. How are you?
I'm doing well. Yeah, I'm excited. This should be episode 6, I believe, when we get it posted. So I'm very excited about it. I have a great guest today and going to talk about a topic that's really critical for business owners, entrepreneurs, founders to be thinking about. So really excited for this episode.
Yeah, no, that is great. And I know you and I talked a little bit before we started this. I like this topic too. And I'm very excited to listen to what your guest has to say, because there are a lot of things in here. What seems to be a simple subject or a simple topic that I don't think a lot of people really consider and think about, to be honest with you. So without further ado, let's intro the guest and get to listening.
Yep. So we're joined today by Stefan Cherneski. He serves as a private wealth insurance specialist for the Professional Life Advisor Network. With specialized experience in business owner market, his focus is to assist financial advisors in growing their practices with high net worth clients and business owners. For his clients, he serves as a resource for customized insurance solutions related to personal, business, and estate planning strategies. And with a background as a tax economist, Stefan understands the needs of business owners, particularly in a challenging and ever-changing tax law environment. He brings multiple carrier access, objective needs planning, and creative tax strategies to each unique client situation. And Stefan's been a frequent lecturer across the country on the advantages of employee benefit plans to both employer and advisor groups. He understands the complexities involved in working with broker-dealers and provides his advisors additional value by becoming an insurance component of their team. And he was born and raised in Canada. He moved to the United States after being drafted by the New York Rangers in the first round of the 1997 NHL entry draft. And after his career was cut short by a knee injury, Stefan attended college at Central Connecticut State University, where he graduated at the top of his class with a degree in economics. So with that, Stefan, welcome to the Pleasant Street Podcast. How are you doing today?
I'm doing good, Taylor, and thank you for having me today.
Yeah, I'm excited to have you here. Obviously, we've been working together for many years. You've helped and been a critical player in some of the planning we've done for a number of our clients. And, we appreciate the work you do and the help you provide to our team and to our clients. So I'm really excited to share the microphone with you today.
Thank you.
One of the things that I think really sets you apart is the decision you made to pursue your CFP. And for those of you at home who aren't listening, the CFP is the Certified Financial Planning designation. It's pretty much the gold standard in our industry. And, I think it's really unique in particular that Stefan, with the insurance focus and background, you still chose to pursue this really challenging designation on comprehensive planning, which touches a lot of areas outside of insurance. So, I guess the first question, just before we get into all the other stuff, is, why did you choose to pursue the CFP, and how does that help you serve your clients?
Yeah, great question, Taylor. I was at a point in my insurance career, a number of years ago, where I was looking for an advantage, right, to be able to grow my practice and expand upon the conversations that I feel that a lot of financial advisors weren't having, but that I could assist specifically with, the business owner market. And one of the things that was brought up to me by a colleague was, a lot of the conversations that I have do center around the financial plan. So to be an insurance professional and also have the certified financial planner designation would not only set me apart from my peers, but allow me to expand my education and allow me to have more comprehensive planning conversations with business owner clients and allow them to open their eyes, so to speak, to how insurance planning can help, protect their business, protect their families, and make their plans more efficient.
Yeah, and I think it's tremendous. And also, where our firm, we start with the comprehensive plan, and then we bring in the solutions to fill the needs of the clients. And it's always great working with you because you have that perspective. Kind of those big picture planning things. So it's one of the things I really appreciate about working with you. But I want to pivot and talk a little bit about hockey. Right, in your bio, we talked about first round draft pick of the Rangers. That's pretty exciting, and I think maybe our guests would love to hear about how that happened, about your journey a little bit.
Sure, absolutely. So definitely for those of you who are listening, you can hear me mispronounce vowels and words and things like that. So the Canadian is full bore in me. So for those of you who are familiar with Canadian geography, or you have the opportunity to look up it on Google Maps, I was born and raised in a town called Thompson, Manitoba, which is 9 hours north of the U.S.-Canada border. So my choice growing up was either to go work in the nickel mine or to go play professional hockey. So I was fortunate enough to be able to choose the latter, and hockey opened up a path for me. And I moved away from home at age 16 to play junior hockey in Canada. At age 18, I was drafted in 1997 by the New York Rangers as their first round draft pick, 19th overall. And then in 1998, I signed my professional contract and I came down to New York to try out for the team. At that point in time, the likes of Wayne Gretzky, Leach, Graves, Richter were still skating with the team, and I had the opportunity to skate with Wayne Gretzky for a number of training camp games and also some preseason games. So it was quite an experience.
Wow.
Unfortunately, I was cut from the Rangers. I was the last cut at training camp and sent up to the farm team to start my pro career in Hartford, Connecticut. And 11 games into my pro career, I suffered a career-ending injury where I shattered my kneecap in 6 pieces. I did have 4 surgeries on it. I did try to come back and play, but unfortunately, I could not continue my career. But looking back on it, it did provide a couple of things for me. My father, at the time of signing my contract, he said, I don't care what you do with your signing bonus. Just a note to anyone on the call, listening to the call here today. If you have a 19-year-old, don't use those words and say that to them. That was not a good idea by my father at that point in time. But what he did encourage me to do was to purchase a disability insurance contract for a career-ending injury. And I did. And I did listen to him in that respect. And, good news, bad news, I was able to collect on that disability insurance contract and start my life ahead of time. So it was quite a journey from start to finish, Taylor, in terms of where I was, where I went, and what happened to me.
Yeah. And then that's an amazing story, and obviously a bummer that, the injury occurred. But to share the ice with Wayne Gretzky, I mean, what was that like? Was he as great as he was in all the highlights that we've seen and all that stuff? Like, what was that experience like?
It was quite amazing. I was a little bit tongue-tied at the start, but he was a great guy, made me feel very comfortable. And, well, the words he said to me, he says, just get open. I'll get you the puck, kid. And that was it. Right? Unfortunately,
Nice.
Mike Richter had some other plans for me on the inter-squad game that day, but it was quite an experience playing on a line with him.
Very cool. That's very cool. So, you talk about the transition, and obviously we're going to talk about insurance and how that played a role. But with a lot of our folks that we work with, business owners, entrepreneurs, when they go through a transition, when they sell a business, there's a significant shift, obviously, about what you're doing every day with your time, but also there's some emotions there where your identity might change. So we talk a lot about, having a why and having a purpose. How did you navigate that transition? And what are your general thoughts around what worked, what didn't work, what would, how did that all play out?
Yeah. In regards to my plan after hockey that I always had, education was a big, uh, very important in my household with my parents and my brothers and sisters. So I always knew that I would go back to school when I was done playing hockey. Unfortunately, that happened sooner than anticipated. So after my path in hockey was cut short, I ended up going to school immediately thereafter. So I pursued my education, retiring at the age of hockey at around 21 years old, which, as you can imagine, is fairly young. And so I was able to put my focus and attention towards that and allow me to have some sort of purpose when I was done with hockey. So in that respect, I think I was really able to navigate that landscape after hockey was finished in a productive manner. I do look back on it and think that some of the emotional things that a 21-year-old would go through when their trajectory was to play potentially in the NHL, and that was cut abruptly short. I think there was some things that I wish I would have done a little bit different at that point in time. But
Mhm.
I do use my story to encourage other people right, for when they are approaching the end, right? Whether it be retirement, whether it's a business owner selling their practice, to have that purpose, right? To have goals, right? Because it's one thing to achieve monetary success, right? A certain level of wealth. But I think to maintain a happiness and have purpose, right? There's other things that go into the conversation that I like to make folks aware of in conversations with individuals such as yourself as well, Taylor.
Okay. And how did you get into insurance? I mean, you graduated as a tax economist, and now you're doing what you do now. What was that journey like? Was it a couple jobs and you knew what you wanted to do, or were you exploring other stuff as well?
Yeah, I mean, as most people in the insurance field, I kind of fell into it.
Hmm.
Finishing up school at Central Connecticut State and earning my degree, I didn't really quite know where my journey was going to take me after that. And a friend of mine who was working in the insurance business inquired to my future plans, and I let him know that I didn't have any at that point in time. So he encouraged me to join the firm that he was with. We're a small boutique insurance planning firm that focused on planning for business owners. And that's kind of where I joined my first job and continued my career from there and progressed into where I am today. So it was by chance, but it turned out to be the right choice.
Hmm. Awesome. So, when you're first working with clients, and I know how you work with us, but just for the audience out there, um, you know, when folks are engaging with you, how do you work with clients?
Yeah, it's a great question. When I'm introduced to clients, usually with a partner such as yourself, Taylor, where we come in to navigate the risk management part of a client's financial plan or a business owner's financial plan. And a lot of the work has been done ahead of time by the partner, such as yourself, where there's a good profile of the client and what they're looking to do, what their assets look like, and what their goals and objectives are. By a lot of that data gathering that's done ahead of time, I'm able to digest the information provided and then pick certain areas where I feel there's some risk management tools can be implemented to help make the plan more efficient from a success standpoint.
Hmm. Yeah. Okay, great. So let's talk a little bit about some of the work that we do together, and some of the things that our audience might be thinking about, or have on their mind. So I think the first question that we see all the time is, you know, how does or I guess why does risk management matter more as wealth increases?
Absolutely. I think at its core, we have to talk a little bit about what risk management means, right? And how we
Hmm.
can plan for it, right? Insurance just being one aspect of that. But from risk management, the question should be like, what happens when life doesn't go as planned? Right. And once we can identify some of those things that can happen when life doesn't go as planned, we can discuss some of the solutions that are available for that. Where I come in, right, we can talk about some certain aspects. The big one from the insurance planning standpoint, when life doesn't go as planned, what happens in the case of a premature death, right? There's
Hmm.
life insurance for that. We can talk about, for my story, is what happens if there's an injury and your ability to earn income is limited or eliminated, right? There's disability insurance for that, right? We
Hmm.
can also talk about the risk of needing care or long-term care in retirement. There's long-term care insurance for that. And then also, as you move up the food chain, there's other risks that you can protect against, right?
Hmm.
Loss of a key employee, loss of a business partner, protect against income taxes, protect against estate taxes, right? So there's a lot of, from a risk perspective, there's a lot of things that can be addressed through various insurance planning solutions and other tools that are at our disposal.
Yeah, and the way that we also think about it is, on the financial side, the more zeros on your balance sheet, the more there is at stake. So we want to try to protect that. And then also the more people that are counting on you, whether it's your family, your employees, charities, institutions that you support. If something happens to you, the trickle down effect will impact all of them. So risk management is certainly something that everybody should be worried about, not just, the ultra high net worth, for lack of a better term. And so, one of the questions I often find when I'm meeting with, business owners, and navigating some of this stuff is, I hear that this will never happen to me. Like that's not going to happen to me. So how do unseen risks show up in business owners' life?
That's a great question, Taylor. The the thing that I see the most with business owners is that the value of their business is tied up in the business itself. And the value of the business, if there is a smaller company with the business owner himself as the primary rainmaker, if something were to happen to that individual, the value of that business could be severely limited, cut in half,
Hmm.
or gone altogether. So for the entrepreneurs that are out there that are trying to ensure the success of their plan, it's highly recommended that there's strategies implemented so that if something were to happen to them, right, when life doesn't go as planned, that there's a solution in place or a contingency plan to preserve the value of that business for themselves, protect their ability to earn an income, and to ensure the continued success of their financial plan and their family security. So I think I like to highlight the fact that if something were to happen, right, there's solutions that we can help implement to make sure that they're protected, their family's protected, and that the success is ensured.
Yeah, so I totally agree with that, and I think that's a really critical piece, right? Understanding how much is at stake and how it can be protected, because as you pointed out, there are a litany of different choices and decisions that you can make about how to protect against these risks. Um, and one other thing too, for those growing businesses, I would add is, and you alluded to this earlier, there's a lot of different types of risk and there's a lot of different ways to manage risk. So we're talking a little bit about insurance now. You can manage by carrying extra cash and having liquidity, but one of the things that people often think about is, well, I've got an estate plan in place, but if that business is increasing in value, all of a sudden you might be triggering other estate consequences, which could lead to larger estate taxes, which can become a risk in themselves. Um, so I think it's really critical for business owners to be thinking about these things all the time, understanding their balance sheet, understanding the value of their business, and understanding the wealth structure that they have to support it. And it's not a decision that you can make once when you start the business and it's good forever. You should be constantly revisiting these plans, right? Would you agree with that?
Absolutely, absolutely. The common theme that I see when business owners or even individual clients for that matter, when they've put a plan in place, whether it's an estate plan, whether it's a business succession plan, it's not a static plan, right? It's a dynamic plan. And by working with a financial professional that is engaged in that financial planning process, it'll allow that plan to be reviewed as an ongoing basis, right? The value of assets go up, the value of the business, and everything that corresponds to that asset needs to be adjusted as well. So I highly encourage everyone out there to engage and talk and to kind of make sure that as life changes, values increase or decrease, that the plan is adjusted accordingly.
Um, so one thing that we talk about with business owners a lot, especially when they're building their businesses or when we first get introduced to business owners who are, have multiple partners, is the idea of, how do you manage the partnership? And, in the exit planning world, we talk about the 5 Ds: death, disability, distraught, meaning burnout, partner disagreement, and divorce. So in the event of, a partnership disagreement, a disability, a death, the buy sell agreement is going to come in and provide that protection, right? And then another question there is, I think we get questions a lot around what is an unfunded buy sell agreement and what is a funded buy sell agreement. So, I'd love to hear kind of your view and perspective around buy sell agreements and, strategies that folks might be interested in learning about.
Absolutely. For those of you listening, to kind of break it down into simple terms about what a buy-sell agreement is as it relates to business owners, think of it as a prenup or a post-nup agreement that spells out the terms of what happens in the terms of separation. And the separation can be any number of things. It could be a couple of the big ones: death or disability. But the buy-sell agreements typically spell out what happens in the terms of a retirement of one of the business partners as well too. And why these are important to the continued success of a business is that if there isn't one in place, typically the assets will flow either to the spouse or the children of the business owner who passes away prematurely. And for those of you that are out there who are in a partnership, whether it be at home or at work, right, to have clearly delineated succession plan is very important to ensure the continued success of any partnership, business relationship, etc. So to have these things in place, buy-sell agreements, and any of the other documents that would accompany them are very important. To go on to the second part, Taylor, about talking about whether a buy-sell agreement should be funded or unfunded, a lot of times when I'm having conversations with business owners who have said, yeah, we have a buy-sell agreement in place, I'm like, that's great. Is it funded or is it unfunded? And the next question is, I signed it. Do I have to do something else as well? And the answer is yeah, or at least we can have the conversation on whether or not it makes sense to do this. In terms of a unfunded buy-sell agreement, that just means that for any of these contingencies that come up, a death, a disability, or a retirement, the business comes up with funds to pay for these contingencies. So for the death, maybe there's a buyout that needs to be structured, and they can structure it over the course of somebody's life, so over time or an installment sale. For a disability, the same thing, right? There can be a payout over a certain period of time, and also with a retirement. So all of these unfunded liabilities can be paid by the cash flow of the business. Now, if the business does not wish to come out of pocket to pay for these, or it may cause a potential cash crunch in the future, they can look at certain insurance solutions to come up with funds to pay for death, disability, or even potentially retirement as well too. So there are insurance solutions that can help offset or pass some of that risk to a third party for business owners who are looking to protect themselves as well.
Yeah. And I think that's really critical for folks to understand, because we have that conversation all the time. Yeah, I have a partnership agreement, don't worry about it. And then you go look at it, there's no metric to value the business. The business is increased in value. It's not funded. They don't, there's not very clear path. So it is important that business owners understand that component, unfunded versus funded. And while you were talking, it made me think more about the exit process, and not everyone who's listening to this podcast is getting ready to sell a business, but for folks who are experiencing liquidity events, whether it's equity comp, your company gets purchased and you have all this equity that's suddenly vested and now you've got a big tax bill, or if you sell a business and you have all that tax bill, we often incorporate charitable strategies when appropriate with folks. Another interesting thing that I've been working on with Stefan and a bunch of other cases is the idea of a wealth replacement policy and how that can work. So I'd love to kind of talk about that a little bit, and just so folks understand, right, how this works. If you have these big liquidity events, if you've got the sale of a business, a large portion of equity comp that gets exercised, and you end up with more cash than you personally plan to spend immediately, and if you're charitably inclined, there's ways that you can do create charitable structures, wealth. There's all sorts of charitable stuff you could do. Donate the stock, create a donor advised fund, private foundation. You can use a charitable remainder trust, charitable lead trust, those types of things. But what ends up happening is assets are moved to this charitable vehicle. So sometimes you might want to make sure that there's another mechanism to bring assets back into the household for your beneficiaries, for the people that you care about, for the causes that you care about. So Stefan, I'd love to hear kind of how you think about that, and any sort of perspectives that you want to share around integrating, insurance into some of those other strategies, and how they can work together.
Absolutely, Taylor. So for those of you listening, wealth replacement trusts are essentially as what they sound like, right? They're a trust that's set up to replace wealth that has been passed along for some other purpose. In the vein of planning for business owners, a lot of times we'll see when they have that liquidity event, they have a charitable inclination. So any assets that are gifted to charity are not going to end up flowing to any of the family members or other intended beneficiaries. So you'll see a charitable plan combined with the wealth replacement trust so that the family is not disinherited. So how the wealth replacement trust would work, gifts would be made to this trust, whether it's part of someone's annual gifts they can make per IRS limitations or an annual or lifetime exemption. And once these trusts are established and funds are placed into them, people can buy life insurance where they can do a couple of things with the product inside of the trust. And that is provide instant leverage in the form of a much higher life insurance proceeds that can be guaranteed and also structured properly, are income and estate tax free for the next generation. There is an option to fund these trusts and not purchase life insurance, but due to the leverage and some of the certainty that the insurance products provide, they are at least explored upon to see if it's a fit for the client's financial plan. And I think further, when people are talking about wealth replacement trusts, in this context, we're talking about using it for when assets are gifted to charity. But a wealth replacement trust can also be for other reasons as well, right? It could be used as a resource that if you're going to spend money for long-term care, the wealth replacement trust can backfill the estate and provide funds for any money that can be spent for long-term care. And in some instances, the wealth replacement trust can serve as a estate planning certainty, so to speak, where they know the legacy that is going to be left to the family, and that allows the clients to spend down their assets more freely since they know that the wealth replacement trust is going to be their legacy tool for their children as well. So a common usage in the conversations that we have, it can be a very powerful tool for those people who are fit the client profile.
Yeah, and incorporating strategies like this and combining multiple strategies, it creates a tremendous amount of tax efficiency and that peace of mind, that certainty, right? We know what the benefit's going to be when the event happens. So it's a really great way to get that combination of tax efficiency in a liquidity event with the guarantee of future outcomes for those beneficiaries. So I think that's a great one to kind of end on. So, with that, I want to thank you, Stefan, for being here. Why don't you tell the folks out there how they can get in touch with you, how they can keep up with you if they have any questions or just want to learn more about what you do and the services you provide?
Absolutely, Taylor. So best way to get in touch with me is either through email or through phone number. And my phone number is, which is easier, I'll give that first, is 860-874-2750. Or my email address, and I'll go slowly here because it's a long one. It's my first name, last name. So that's Stefan, Stefan, Cherneski, Cherneski, at life, which is singular, advisor, which is singular, and then solutions, which is plural. So Stefan Cherneski at lifeadvisorsolutions.com.
That is great. Stefan, thanks for joining the podcast. That was a really interesting set of information, I guess I would call it. But the thing that struck me is that you have tremendous credibility talking about the idea of replacement insurance and planning for events that people don't think are going to happen. So thank you very much, and we appreciate your perspective. Taylor, for those of you who are listening to this podcast who might want to reach out to you, have a conversation with you, what is the best way for them to do that?
Yeah, so in the show notes, there's a link to book a conversation. If you want to have a 20-minute quick conversation, that's a great way to get started. If you're not sure you want to have a conversation but want to keep up with our content, you can follow me on LinkedIn. You can follow this show on YouTube. And then if you're someone who has experienced some growth or is wondering how you're doing in relation to how you want to be doing, we've got a great 2-minute quiz right in the show notes, and you can go through the quiz. It'll give you an output based on different criteria. How aligned is your wealth with what you're doing? How is your risk management related to this conversation? How well is your team integrated on your behalf, working to help you achieve your goals? So it's a great quiz to get a sense of where you're at. And then, of course, obviously, those other two options, LinkedIn and booking a meeting.
Yeah, and speaking of the show notes, it's also a great place where you can check in and you can get Stefan's information as well, especially if you were in a car and you weren't able to write things down as he was handing it out. So it's there. Just check into it later at your leisure. There's another thing you could do right away, actually, that's pretty pretty simple, is that if you're not yet a subscriber to the podcast, reach out and hit that follow button. Become a subscriber. The bonus of doing that is that every time Taylor drops a new episode, you'll be notified, and you can give that one a listen. The other thing I would ask is, if you like this podcast, if you find the information interesting, useful, tell people about it. Word of mouth is really invaluable. Nothing like people recommending things to people as opposed to bots recommending things to people. So please spread the word. We'd very much appreciate it. Until next time, I'm Bill Tucker on behalf of Taylor and everybody behind the Pleasant Street Podcast. Thank you so much for listening today, and we'll catch you next time.
Thank you for joining us on the Pleasant Street Pod. Be sure to follow the show so you never miss a new episode. To learn more, visit pleasantstreetwealth.com or give us a call at 518-363-9363. The views and opinions expressed in this podcast are those of the guest and do not necessarily reflect those of Pleasant Street Wealth Advisors, LLC or Farther Finance Advisors, LLC. This content is for informational and educational purposes only and should not be considered professional investing advice. Always consult your financial advisor or another qualified provider with questions about your investment planning.